Hi everyone, thank you for joining us. My name is Jamal Khan. I'm a senior tax partner at Churchill Tax. I've got our tax director Hazel Johnson with us. Hazel is a tax barrister. Myself, I'm a chartered tax advisor, and our team, me, Hazel, and our team work mainly to help people, high net worth individuals, reduce their tax liabilities. Our focus is on real estate and medium to large businesses on restructuring. Today's topic is the use of offshore trusts and whether they're still viable. Hazel is a specialist in that area, and so we will quickly take you through what the latest news on the offshore trusts are and how they're taxed, and whether, as said, that they're effective for UK residents. Hazel, over to you, please.
Okay, so I'll just share my screen with you, and hopefully that will bring up some slides. So we're going to be talking about offshore structures today. And I should say that this is the part of a monthly tax planning and tax update series, and you can subscribe to our YouTube channel and join our live webinars. Churchill Tax Advisors are a specialist tax advisory firm based in London and Essex. We offer national coverage and we deal with a wide range of taxes. So I'm going to talk about offshore trusts for both UK domiciliaries and non-UK domiciliaries, although the clue is that offshore trusts really don't work very well for UK domiciliaries, and offshore companies with a bit about UK land, which sort of has special treatment these days. So we do get people coming to us who have sort of spent their time reading about things online and thinking that offshore trusts are a way of avoiding tax, probably because, you know, places like The Guardian are always waxing lyrical about the evils of offshore trusts and how people are using them to avoid tax. And this sort of hasn't been true for about 25 years, certainly for UK domiciliaries, because it's a look-through for capital gains tax, it's a look-through for income tax, and for inheritance tax, it's also a look-through. So before 2006, if you had a life interest, it was treated as if if the trust assets were in your estate, and now you have we call non-life interest, which means it's treated like a discretionary trust. So you get a 6% charge every 10 years. So there's absolutely no tax savings available to a UK domiciliary on setting up an offshore trust. If you are a UK domiciliary and you're a beneficiary of an offshore trust that somebody else has set up, then you could still get some tax advantages, but they're not. It's not necessarily the best structure for you, and you would be better advised to look at different structures. For non-UK domiciliaries, they still do offer some advantages because the recent changes have introduced what they call protected status for both income tax and capital gains tax. So if you set up an offshore trust before you become deemed domiciled in the UK, which happens after you've been resident here for 15 out of 20 years, Or you are not resident or domiciled in the UK, but you have relatives who are resident in the UK, so you want to set up an offshore trust for their benefit. It's not a look-through for income tax and capital gains tax purposes, so you can get the benefit of a roll-up tax-free in the structure, with some exceptions for UK land, and people are only taxed on receiving distributions out of the trust. However, when you are setting up these trusts, it's important to bear in mind that if you add funds after you've become deemed domicile, you lose the protected status, and then you fall back into the transparent treatment we were talking about in the previous slide. And adding funds has a very, very wide definition. So it includes loans being given on non-commercial terms, and other sort of incidental benefits that the settlor is conferring on the trustees. So assuming you have a protected trust, your capital gains that are realised by the trustees are added to a pool, and these are available to be matched to distributions to beneficiaries. And the same thing happens to an income tax. So the income that arises in the structure is added to a pool, but this matches in priority to the capital gains tax pool. And it also includes the income of the underlying entities. So any distributions out of the trust are broadly going to be taxed to income tax, because that income tax pool is always going to be matching in priority, and it's always generally going to be larger than your capital gains tax pool. So what you are getting is a structure that allows you to roll up tax-free within it, which, you know, is obviously attractive. And then you are only going to be taxed on distributions out of the trust. Whereas after you've lost your non-domiciled status, you are going to be taxed on worldwide income and capital gains. So it does still act to some extent like a tax shelter. For inheritance tax, the position is a little more complicated. So as before, it's similar to the trusts for UK domiciliaries, where you have that concept of either recognised or unrecognised life interests, but you have excluded property. So if you have a trust that owns nothing but non-UK property, then when you are considering what the tax charge is, you don't take into account that excluded property. So if it just owns an overseas company with investments beneath it, then that's going to be free of inheritance tax. You do have to watch the adding funds or making transfers between trusts once the settlor has become deemed domiciled, as you can then lose the status of that trust as being as holding excluded property, and that can cause complications and difficulties when calculating your tax charge, and can mean either tax charges or running a trust that's so complicated that the computations can be almost as much as the tax charges. Now, for UK land more generally, offshore trusts really aren't a suitable structure for holding UK land, because as of April 2019, an indirect disposal of UK land is going to attract capital gains tax. And that means that if you have a company owned by a trust, and that company is property rich, and you sell that company, then the value that relates to the post-2019 element is going to be brought into charge to the trustees. So that's different from the position we were talking about before, where there's no tax charge and it goes into a tax pool and it is matched to distributions. And for sort of trust company structures, a direct disposal brings in the increase in value since April 2015. So that means that if your trust company structure owns a house and that house is sold, then the company is going to be paying capital gains tax on the post-April 2015 increase in value, and the other sort of capital gain is added to the pool and is capable of being matched to distributions. There was also what we called ATED, which was a sort of an annual tax charge, because people were concerned about, well, the government was concerned about stamp duty land tax being avoided by these structures. So you'll be paying an annual charge, and that also brought in capital gains tax charges as well. So you have a situation now, if you've got a trust company structure that's owning UK land, it faces a series of tax charges that can apply on a simple disposal of a property. So it's always worth seeking advice on that. From the point of view of inheritance tax, UK land that's indirectly held is not excluded property anymore, whereas it used to be. It used to be only directly held UK land that was subject to UK inheritance tax. So if you've got a historic offshore trust that's holding UK land, you have a whole raft of very complex legislative rules that are applying to it, and it's always worthwhile seeking professional advice on how to deal with your current tax situation, and see whether it's better to wind up the structure perhaps, or if there is something you can do to mitigate any of the tax charges. We also have a lot of people seeking advice from us about offshore companies. And again, people sort of seem to think that you can set up an offshore company and it's going to be able to receive income, trading income, income from a property rental business, and that's not going to be subject to UK tax. And as with all of these things, it's not quite that simple. So the first thing you have to think about is, how are you going to have a non-UK resident company? So you have to be very careful when you're setting it up that you've got management and control outside of the UK. You need a board of directors that's outside of the UK, and you need to exercise a great deal of care and control about the decision-making process to make sure that that's being done outside of the UK. That doesn't mean you can't make any decisions in the UK, but if you're going to be sort of running aspects of a UK business from a non-UK resident company, you're going to need to think about how that's going to be ratified by the board, or what sort of agreements you have between the board and the person to whom they're delegating the decision making. You also have to be aware that there are also rules about sort of permanent establishments, which says if you have a non-UK company and it's trading through the UK, then the profits attributable to what they call this permanent can be taxed in the UK anyway. And the rules about determining what is a permanent establishment are quite wide. So it's not just limited to having premises in the UK, but if somebody continually visits the UK and runs their business from a hotel room, that too can be a permanent establishment. There are also a raft of anti-avoidance rules to do with what we call close companies, which is one that's under the control of 5 or fewer people. So there's something called transfer of assets abroad legislation, which can treat the income of the non-resident company as being the income of a UK resident shareholder. And there are similar rules for capital gains tax. And these rules only apply if you don't have a genuine business case for establishing your offshore company. So if you've set up a company in Dubai and you do a lot of business in the Middle East, then you've got a fighting chance of arguing that that's the reason you've chosen Dubai as the place you want to do business in, because it makes sense for you on a commercial basis. You can also sort of segregate elements of your business so that your offshore business is dealt with through offshore companies and is kept out of the UK tax net, and you have a UK business, and you can sort of contract between the two of them about providing services and things like that. And at that point, sometimes the transfer pricing rules can apply, so that if you're sort of charging large fees from the offshore company onto the UK company to shift profits out of the UK, then HMRC can have a look at that and go, well, we think that you're charging too much, or you're over egging the pudding, as it were, and they can seek an adjustment. So again, you need professional and experienced tax advice on how to navigate all of these issues. So in summary, I would say that offshore trusts are not as beneficial as they were. And that's particularly the case for UK domiciliaries, but for non-UK domiciliaries, they still offer some tax benefits. And offshore companies can give you some advantages, but there is a lot of anti-avoidance to consider to make sure that you're not going to be caught by any of those rules. And these are our contact details. So Jamal Khan has been a chartered tax advisor for 24 years of experience, and I've got sort of 30 years of experience in senior tax advisory roles, and I've qualified as a lawyer and have a lot of expertise in doing sort of offshore work.
Great, thank you, Hazel. That's very useful. One question I have from the audience is, are you expecting any major changes to be announced in the coming budget on offshore trusts?
I don't think so. I don't expect many big changes in the coming budget at all, because I think we're still at the stage of the pandemic where we don't know what the future looks like. And I think Rishi's going to be doing any large changes in November, although I could be wrong about that. I think that all the changes to offshore trusts that are going to be made have been made, because it's only sort of 2 years since the last big raft of changes. So I don't think there's any appetite for changing those at the moment, because we're still working out the effect of the last set of changes. I think he's going to be concentrating on, UK CGT rates and things to generate economic growth over the sort of short and medium term. So I think it's going to be a very UK focused budget, and not necessarily, as I say, changes in this one, but in the November one, certainly.
Great, thank you. I think you've explained everything quite well. I don't have any more questions for the moment. If anybody's got any more questions, do get in contact with us. We have contact details, and they would be more than happy to help. Thank you very much, everyone. Thank you, Hazel.
Okay.
Bye.
Bye-bye.